This is a discussion of Silicon Valley real estate market ending the week of February 14th, Valentine's Day. These are the key chapters we're going to be going over and the corresponding graphics. Personally, I like to listen to the summary and then go into the micro market areas, which is chapter 8, although a lot of people like the distribution graphs, and then people that want an overview versus specific, chapters 3 are good because that goes into Silicon Valley as a whole instead of individually. The concept of the chapters is you can go down and get the timestamps in the description, jump to the portions you like the most, and just watch those sections. And appreciate subscriptions and likes. I'm Richard Calhoun, real estate broker with Creekside Realty, representing buyers or sellers here in the Silicon Valley. And my contact information is at the bottom of every slide. Let's get into the first data slide. This is sort of the summary of the key indicators. Inventory is obviously how many listings are available for the consumers to purchase. We have 3 thin lines up here. We have the blue, which is the most inventory you'd expect, which would be a cool marketplace. Blue is for cool, ice cold marketplace. The gray is the 10-year median for that particular metric. And the red is the metric, the 90 percentile or the 10 percentile that favors the seller for a red hot marketplace. And the purple in all cases is thicker, and that's the current data line. You can see that inventory was very limited for the end of last year. Coming into this year, we went from very limited inventory up to typical inventory, which is that 10-year median. And now we're actually 7% above the 10-year median. So we have a little bit more inventory than we typically do for this time of the year. My calendar year starts on March 1st. I jump forward 7 days at a time. We're coming up to February 21st, which is next week. At that point, instead of jumping forward 7 days, I jump forward 8 days to get back to my March 1st start fiscal year. Offers accepted are sort of the same concept, but the reverse, how many offers have been accepted? These are not closings. These are offers accepted. How many offers transactions were started? You can see that we started off on the cool side with only 80% of the number of offers you'd expect. We dropped below the least number of offers you'd expect, and we're back now in between the typical, the gray line, and the least you'd expect, and we're at 91%. So the percentage of the market has picked up, but it's basically gone from 80% to 90% for an increase of 10% of the marketplace. Meanwhile, your inventory went from 88% to 107%, basically an increase of almost 20% of the marketplace. And for those that have been claiming we were in an inventory limited marketplace as far as volume of offers, that clearly indicates to me strong evidence we weren't, because your inventory has gone up twice as much as your offers. If the inventory was restricting your offers, if you had a 20% increase in inventory, you would have had a 20% increase in offers. DUI is the seller-buyer balance, the supply-demand balance in economic terms. You went from basically exactly normal 100% at 38 days. Now you're at 37 days, not much of a change, but you've gone up to about 7% above the marketplace. So the market's 7% slower. That's why you're now slightly above the gray line. You can also see, because of this time of the year, the market's typically fairly quick. We are also very close to the blue line, which is the slowest marketplace you'd expect. So even though we're still close to the typical, we're not that far away from the slowest you'd expect. Marketing time, days on marketplace, instead of looking at the average or median days on marketplace, as most people do, I look at the 75th percentile. The reason for that is average days gets impacted negatively by a particular listing that's been on the market for, say, 2 years and sells. That brings up the days on market, the average days on market. Median is a bad indicator for this particular metric because about half the sellers here in Silicon Valley accept offers as soon as they're willing to accept offers. That's why I went over to another data point a lot of economics people use, which are quadrants. This is the third quadrant, the 75th percentile. How long does it take 3 out of 4 sellers to sell? You can see it was 31 days, which was basically right at normal, 99% of normal. Now it's only taking 14 days. So not only have you cut the marketing time in half, you're now only 31% of typical. Typical is way up here, and yet you're way down here. What's going on? I think what we're seeing, and I threw this out about 2-3 weeks ago for the first time, I think you're seeing an influx of inventory greater than the buyers are buying it up. So right now, the only activity that's happening is at the very new listings that are coming on the marketplace. That's satisfying buyers' demands. So you're seeing a very low number of days on market. You're not seeing any buyers getting desperate and going back and pulling and making an offer on a property that's been on the market for 30 and 60 and 90 days, or at least that's happening less often. Price cuts. This is how much, and it's the average price reductions. And so you look at what the seller's original price was and their ask price at the time the offer was accepted. So you don't have to wait for escrows to close. It's a very tight metric because, as I was indicating earlier, a large number of sellers don't do any price reductions whatsoever. You can see it's 0.9%, so less than 1% price reduction, and that's 80% of where it typically is. So normally you're taking a little bit larger price reductions, and that was where we were a quarter ago. And now you're at 0.4%, less than half of 1%. You're basically right at normal, and it's all actually 91% of normal. There's less price reductions going on right now than there typically is. Buyer overbidding. And now instead of looking at a percentage of what it typically is, I'm just doing raw counts because a percentage on a percentage gets confusing. Typically, you were at 4.3% a quarter ago, and in a quarter ago, we were actually at 6.2%. So that's basically 1.9% higher than it typically is. A more aggressive overbidding, which is why the purple line is above the gray line and on the red side. Currently, we're typically only at 3.5%. And right now we're at 5.3%. So we're 1.8 percentage of the seller's ask price more above their ask price than we typically are. So we're typically at 3.5. You add 1.8 and you get to the value of 5.3. It appears from this chart that we have a fairly robust marketplace. My biggest concerns, it's the fact that right here that we're selling only the stuff that's been on the market for a very short period of time. That tends to indicate to me that we have more supply than we have demand. Yes, we have pent-up demand, so that's being fed right now, but it's only being fed on the brand new stuff. No buyers are getting left over for week number 2 and 3. Now we're looking at the long term. We go all the way back to January 1st of 2015, coming up through January 1st of 2024 on the condensed scale. Then once we hit January 1st of 2024, I expanded roughly 2x so that you have more horizontal space here to see the trends. You have 3 indicators. Inventory is the purple line, and you can see that inventory right now is approaching 108% of where it typically is. So more inventory than it typically is. And look how rapid this has increased. I mean, at the beginning of the year, we were only at about 73% of normal. So you've picked up 35% of the marketplace. So your inventory has grown by a third in just the last, what would that be, 7 weeks? To me, that's pretty significant. You can see that we had that kind of rapid growth here right before the slowdown in 2022. We also had it right before the slowdown in 2019. Are we getting set up ready for a slowdown? Anything's possible. It's something that warrants paying close attention to. Then we're going down to looking at offers. You can see offers have been coming up, but you can see they're not coming up as much as the inventory. And they're also looking like they're falling further and further behind. Initially, they were keeping up because there's a 1-week lag, but now we're almost at a 2-week lag. So a 1-week lag happens because the listings came on this past week. The offers don't get accepted until next week. But now you have like a 2-3 week lag through here. It's getting to the point where something's happening. But then when you look at the speed of the marketplace has gone from 116, 117% of normal, so 17% slower than it typically is, down to about 7% slower than it normally is. In fact, it was 7%. So the market's actually improving compared to where it normally is. So it's not as slow as it was about 3 or 4 weeks ago. So definitely some mixed signals. Now we're looking at the inventory going all the way back to 2015. Again, you have the condensed scale through 2023. Starting in 2024 for a year, you have the expanded scale. You can see that at the beginning of the year, we had the least amount of inventory you'd expect right on top of the red line. You can see we really quickly got up to the gray line. We've sort of followed along the gray line, and now we appear to be pulling away a little bit even from the gray line. We're not much towards the blue line, but we're appear to be heading towards the blue line. Again, warrants keeping a close eye on what's going on. Here you can see the growth in inventory. So if the inventory was growing at the normal rate, it would be a horizontal line at whatever level. So if you were down here, and for most of 2024, we were at somewhere around the 80%. Yes, so the latter part of the year, you were closer to maybe 85%, but the beginning part of the year, you're closer to 70%. So let's call it 80% or 82%, something like that. If the inventory was behaving normally, it would have been a normal at 82% and going along here. Instead, you rolled over to the first of the year and you had this rapid growth of inventory. And you really see it in this graph. Here's now looking at offers. And again, you can see offers were right down and slightly below the blue line there for a couple of weeks. It's came up and it's the vertical separation. To me, it looks like you're going from a cool marketplace, less offers than you expect, towards the typical, but you're still a little bit less than normal. And we'll see that better on this slide. So here you are in a cool marketplace and you're going towards normal, but you're still not at normal. And I think that number was about 91.5%. Again, the offers have gone up rapidly, as did the inventory. but they're not going up as much. And they're also still below 100%, lower number of offers accepted than you would expect for this time of the year based on the data, where inventory is now a greater number. Here's the days unsold inventory. This is the seller supply demand ratio. How fast is the market turning over? And again, you can see the market's turning down. That's why these colored lines are so important. Normally at this time of the year, it comes flying down. It might have come down 1 week earlier than it typically does using the gray line, but you're still on the blue side of the gray line. You're improving, but you're still on the cool side of normal. Here you're improving because the market's getting faster. Again, with DUI, a high number is a slower marketplace, which is why blue is up here. So you're lower than normal, but you're improving. You're going towards the 100% line. And you can see the last part of last year, we were right at normal. Here's looking at that 75th percentile. This is sort of the metric that is interesting in a lot of ways. One is notice how much earlier the downturn happened. And if you go back in time, I don't think there's another year where the downturn happened before the beginning of the year. So you go to every line, they're always after the new year. So each bold line is the new year. The thinner gray vertical lines are your quarters. This year, the purple line, depending on how you want to terminate this, 2 weeks before to 1 week before, it was basically flat. Then right after the marketplace, it turned. But typically, you're not turning until just about this time of the year. So we turned much earlier, and I have no idea why that was. And it's by more than 1 week. Typical, you can see the purple line has very much the same pattern as the gray line here, but you can see the horizontal shift back in time. That shift has occurred. We came down here. We're now at some of the lowest numbers. You can see that we're starting to round off from last week. We're getting down to record low numbers, which would all tend to say we have a fast-paced marketplace. But if we really had that strong of a marketplace, your number of offers would be going up with your inventory, and that's not happening. So it's a combination of those two data sets that have me a little concerned, at least watching. Here, where you're now comparing it to normal, you can see that you're improved and you're only at that 31% or 33%, I forgot what it was, of normal. And I may have to change my y-axis next week because we're now basically second place only to 2022, just before the market turned. The market turned, in my opinion, on February 14th, Valentine's Day. Are we going to see the same turnaround this year at the same time frame, Valentine's Day? So I'm very curious to see what next week's data is going to be. My suspicion is it's going to be down. I don't think it's going to be down as much as we've been going down, but I think it's going to be down enough that I'm going to have to change my y-axis. Here is looking at the largest sellers that are doing the largest price reductions. I'm ignoring 90% of the marketplace and only focusing on the sellers that are taking that largest 10% of price reductions. And the reason I do that is the vast majority of the sellers do no price reductions whatsoever, but you can see that the price reductions have been going less and less frequent until just the last couple of weeks, and we've rolled over. And because it's normally getting less, for the last couple of weeks, we've now actually seen sellers effectively increasing their price reductions. It's not a larger number of sellers, but since there's normally fewer sellers taking price reductions, typically all the way through first quarter, and we've already rolled over, that to me is starting to suggest that some of the sellers that came on the marketplace right at the first of the year, didn't get selected the first week by the buyers. They've now gone through several weeks and they're not getting the activity anymore. And we're actually seeing an increase in price reductions. Again, that would be a suggestion of a cool marketplace. There is no way to know what the data is going to do, which is why I look at it on a weekly basis. But my suspicion is we're going to cross over and be on the cool side of the normal line next week. And we can find out next week at this time. Now, how's that compared to normal? You can see the normal price reductions. According to this graph, we were less price reductions than normal. You can see how we went over and we had fewer and fewer price reductions. Again, if the market was behaving normal, you would have been flat at somewhere around 17% more price reductions than normal. But instead, everybody was optimistic and we lost a lot of the price reductions. We went from, say, 117% typical price reductions down to something about 82%. So you lost somewhere around 34% of the price reductions that you normally expect. We've turned around in just the last couple of weeks and we've gathered the back 17, half of that 34%. And based on the steepness of the slope and no indication that it's rolling over, I would expect next week we're going to be up here on the blue side of the normal line and continuing to see more price reductions. Now we're looking at the average price reductions. This is just sort of, it's a valid number. I put it on there because most people would rather look at average or median, and I myself would rather look at average and median unless I have a strong reason to not. And I believe that for price reductions and for days on market, I have strong reasons not to. But just to show you there's no real difference in the data, you can see we were taking dramatically fewer price reductions over the last couple of weeks, basically since the last week of 2024, all the way through about 2 weeks ago, we were taking fewer and fewer. Now, this last week, we took a little bit more price reductions than normal, and we appear to be right at the average line. So we went from a fewer than expected, a seller's marketplace, towards the balanced marketplace, and we're now right at a balanced marketplace. Where were we? Fewer price reductions than normal, favoring that seller, coming back towards the normal marketplace, but still a little bit short. So we've been cooling off. My gut feeling is this number is going to start going down further and be in the blue territory potentially as early as next week. Here's the frequency of price reductions. So how common are seller price reductions? Here, the frequency of price reductions basically is tracing the line fairly well. We don't have that big horizontal off shift that we saw on the magnitude of price reductions. Where are we? We're having less price reductions than we typically do, and we appear to be following the typical pattern. So I expect to be basically close to horizontal on my line, but I expect to be a little bit on the red side. So let's go see where we are. We're on the red side, but my optical illusion really wasn't very accurate because we were taking fewer and fewer price reductions, which I got. We were average for the past couple of weeks, going pretty much horizontal, but this last week we actually saw an increasing number of sellers taking price reductions. And that's why you plot it both ways. When I looked at the previous graph, I really thought it was going to be level. You come over and you look at it, and you can see that we're actually starting to already see more price reductions. Here's the magnitude of overbidding. So this is how much competitiveness do the buyers feel when they're making their offer, when they're submitting the offer. Because basically, a buyer's not going to want to offer more than he has to, or they feel they have to, in order to get the property. When they feel they have to or offer more and more, that's a more and more competitive marketplace. It's following the pattern of the normal marketplace. It's above, which means more overbidding than normal. And I would actually say it's pulling away a little bit from the gray line. So in this case, I expect the next chart to be a little bit above on the red side of the gray line, and I expect it to be pulling away a little bit. Okay, I got that one right. On the red side of normal, because you're above the gray line, which is your normal. This is just taking that curvy gray line, pulling out straight, and we're getting further away from it according to the data when you do it mathematically. Basically, math is the right answer. Optically, sometimes you get optical illusions. Here is the frequency of overbidding. So you have the magnitude that we just finished of overbidding. Now, frequency, how common is that overbidding? It's actually more common because your data line, your purple line, is above the gray line. And it's not the horizontal separation, it's the vertical separation. So it's pretty steep here. But again, the slope seems to be matched. So I'm expecting the next slope to be somewhat level, maybe getting a little steeper and on the red side of the gray line. So you're on the red line side of the gray line, and you are definitely getting quite a bit steeper. So again, a little bit of an optical illusion. You're now getting 10% more overbidding than you typically do on the frequency. So if you had 50% of the sellers getting more than overbidding, you'd now be at 55, and the true numbers are probably more like 60% typically, now about 66% in real terms. Here's your long-term pricing. The line through here is just my linear slope, and it was not calculated. Realistically, it probably comes up more like this, and then levels off a little bit through here, and then it's really flat the last several years. If you come back, 2021, we were already at 1.5 million. We just left 1.5 million again. There is a lot of fluctuation depending on the time of the year. Some of that is market mix. Some of that is actually property values. As the buyer demand comes out, values tend to rise. As the buyer demand wanes, property values tend to decrease. Also, it's my perception that less expensive homes, smaller homes sell during the holidays. And it makes some sense. If you're buying a larger home and you have a family, the holidays may be more important to you, and therefore they make up a smaller percentage of the marketplace. Larger families may have children that attend school, and they may want to move during the non-school year to not impact the child in school. And so there's a shift in the marketplace. There's also shifts in the marketplace based on interest rates, on whether loans are more or less affordable. With the raise in interest rates that we obviously have had over the last year, the segments of the marketplace that depend on interest rates may be having fewer transactions. But anyway, you're down, you're coming up. But if you look first quarter, you typically have this run up. What's noteworthy for buyers and sellers, during second quarter, you sort of hit your peak, but then you come back down again. So you're still probably better off purchasing it quickly. But if you start buying halfway through second quarter, you might be buying at the peak. And would you be better off delaying? My basic philosophy is you want to have multiple choices of properties you're interested in. You want to find the property that best meets your needs, so you're in it for long term. Because if you buy 2 houses in your lifetime instead of 3, you're financially better off. Unless you're doing a flip and playing capital gains, then you want to be flipping the property every time you have a net capital gains of $250,000 for each of the owners of the property. Here is now looking at the monthly payments for the properties. The gray line is your median price. Blue line is your cheapest 10 percentile, which would be somewhere just over $6,000. This assumes the Freddie Mac high balance conforming loan limit that's easy for me to get off the internet, not necessarily what's typically used here in Silicon Valley. Typically, jumbo money is actually cheaper for the last decade, 15 years, something like that, where before that it was actually more expensive when you went into jumbo money. The median prices are somewhere right around $12,000, and your most expensive 90% loan, which you're not even going to be able to get an 80% loan, but for comparison purposes, if you did, the payment would be about $27,500. Here now is the distributions. These are, in my opinion, valuable because instead of just looking at the median number, which is right over here, and the reason I don't look at the median, look how close together that is. Now, if you come out to the 75th percentile, the vertical separation is much greater. In fact, look at this is the hottest marketplace down here that we ever had, the dashed lines. This is the coolest marketplace. On the 75th percentile, you went from 60 days all the way down to something like about 12 days. You had a factor of 5 difference, but it's going from 12 to 60, there's a significant range. If you now come down here, you've gone from maybe 9 days up to maybe 27 days. So you've only had a factor of 3. It's more condensed. And then in the range, it's closer. If you look at the data, typically, it's hard to read the data. You may be gone from something like 10 days on the marketplace up to a high of 17, 18. So it's really not changing, where if you come up to the 75th percentile, you now say, hey, you've had a change of somewhere around 12 days, all the way up to a change of somewhere around 43 days. That becomes a lot easier to see. You also notice interesting things, like at the end of the year, notice how the graph's sort of nice and shallow. As we got into the beginning part of the year, these solid lines here, notice how it got steeper, and we're right now at sort of the steepest marketplace. You're now expecting this market line to cool off through the dotted lines going forward. Anyway, what we do is we start off a year ago on February 14th, 2024 with dotted lines. We jump forward 1 week at a time for a quarter, then we do 2 quarters doing every other week, and then we come back and finish up with a quarter doing every week. And the most recent lines are the solid lines. The reason we're looking at data that's from a year ago is real estate has a huge annual cycle. And if the market got better a year ago, the market will most likely get better from the current value. So what you want to do is you want to look at the purple line here relative to where we were a year ago. So a year ago we were here. So the purple line's lower, it's close to the red line. And you really can see, if you come back here and look at my percentile, there's essentially no difference back here at the 50 percentile. So you couldn't tell any difference from this year to last year. You come up out here to the 75th percentile and you can start seeing the slowness. You come up here to the 85th percentile and you can see that this year is really faster than last year. So this is the kind of value that the distribution has. You get to see the whole distribution week after week. So let's step through. Okay, so the data improved. Now it's flattening out that I talked about. So I expect the purple line to do the same thing. There's the peak of the marketplace around April 19th, and now it's going to slow down. You can see it, and notice how flat it is. It's basically almost a straight line. And so I expect to go from the steeper, flatten out, and going down and then back up. And now we're slowing down at the end of the year. Look how rapidly it slows down. There's sort of the slowest of the year, January 10th. And now notice how steep the line's getting. The green line right back here has a bend in it. The bend goes right through here. You can see the patterns. So again, what do I expect? I expect the purple line to get even hotter next week, faster paced, but I also expect to see this high end side here, the 90 percentile, to come down more. So I expect it to come from here down to, something like that. I'm not really trying to indicate the marketplace, but basically from where the bend is right through here somewhere, I expect the right-hand side of that bend to get flatter. Same concept with price reductions. Now what we're doing is we're looking at the largest price reductions. Here is sort of a unique metric. You only go from 2.5%. So I'm ignoring the sellers that are taking the largest 2.5%. I'm saying those are anomaly. And then I'm going all the way down and only looking at 17.5%. And the reason I'm ignoring the 82.5% that are higher percentage, less price reductions is the vast majority of those are zero. Look at the purple line. The purple line basically hits zero back here at 90%. Once you hit zero, you can't get more price reductions. In fact, I'll point out these overshoots here are just some phenomena of Microsoft plotting the graph. This is a data point, this is a data point, so it sort of smooths it out the graph and assumes there's overshoot. Rest assured, you can't have negative price reductions. So the line comes up and hits and then goes completely horizontal. And I wish I knew how to change the linear interpretation that's happening when you tell it to plot your data. If I had more data points, but that's more calculations and I'm already running out of calculation time. These lines actually come up and go flat. As I was saying, there's no overshoot and smooth arcing curves that Microsoft Excel shows so eloquently. And again, the concept is the same. You want to start off where you were a year ago. So you're having less price reductions than you were a year ago. But notice the shape of the line is a little different. No more at the top end here, from 5% to 2.5%, the price reductions are identical. It's only from the 5% to the 12.5%, if there's any difference. But again, this year is less price reductions than last year. But the concept is, which way does the dotted line go? I suspect the dotted line is going to go up and then back down, but we'll find out right now. Yep, there it goes up. You can see up a little bit more, up. There's sort of the peak around April 5th and April 19th, coming down. Now you can see there's a little bit of change in shape. So basically, I'd expect the purple line that we're going to be coming up to, well, you can see that right there. Now, end of the year, very less and less price reductions, and boom. So where do I expect it to go? Based on last year's data, I expect to see fewer price reductions in the near term. And there is no time lag on this because I'm looking at the price reductions of when offers accepted. Because when the offer gets accepted, we know what the original list price was, and we know what the list price was at the time the offer accepted. So unlike the next chart for overbidding, this is a lagging indicator because now I have to wait for escrows to close to get the data. So the purple line is where we are this year. A year ago, we were down here, so cooler marketplace across the board. These are when it's horizontal right on the x-axis, those are the people that are getting exactly their ask price. So you can see it's something like from about 57.5% to something like 67.5%. So roughly 10% of the sellers get their ask price, and roughly 27.5% of the sellers are getting less than their asking price. And here you have 57.5% of the sellers getting more than their asking price. Stepping through, so we're down here. You can see now, remember this requires closings. So there's going to be a lag time. So even though these are closings on February the 14th, they were negotiated basically at this time of the year about 4 or 5 weeks earlier. Actually, it looks like we're just about at the bottom of the marketplace. So I'd expect the amount of overbidding to get more competitive starting as early as next week based on the graphs that I just saw. And now you're going through the summer slowdown. You're about the same level as we are right now. And then at the end of the year, they're coming up right pretty soon. You're going to start slowing down, probably right there. Slow down, slow down, slow down. Less and less overbidding. There's sort of the bottom of the marketplace, January 24th or January 31st. And we've already gone back up. So since we've gone up from last year, yes, I would expect this graph to continue to go up. So there's no more down. I would expect to see buyer competitiveness overbidding to start increasing week after week. Now what we're doing is we're looking at the 3 counties, San Mateo County, Alameda County, and Santa Clara County, that make up Silicon Valley. And we're looking at them individually. You can see that active inventory has increased in all 3 areas. You can look at historically, that typically does. But I will point out that historically, Santa Clara and Alameda County has more similar inventory than they do now. Alameda County has almost 800 listings, where Santa Clara County only has about 550 listings. So Santa Clara County has less inventory than Alameda, or Alameda has more than Santa Clara instead of being the same. And you can see the difference happened basically starting in second quarter of 2024. This is looking at offers accepted for the 3 counties, and you can see Alameda County has the most offers accepted in the gray line. It's right at the 650 line. The blue line is Santa Clara County. It's just below it, maybe 640. And then San Mateo County, being smaller, is down here somewhere around 275 offers accepted. Moving on to days unsold inventory. This is the supply demand ratio, how quickly the market's turning over. You can see Santa Clara County is the fastest at 30 days. San Mateo is next at 40, and Alameda County is at the slowest at 42. But let's put that in perspective. That would be selling out your entire inventory, today's entire inventory, in the next 6 weeks if there wasn't new inventory coming on in the marketplace. A lot of people that I hear talking about the nation real estate marketplace talk about normal inventory being 3 to 7 months. I say the normal marketplace for Silicon Valley is somewhere between 40 and 80 days. So between call it a month and a half and 3 months at most, a month and a half to 2 months is probably more realistic of what a normal marketplace in Silicon Valley is. It's just a different animal. And that's one of the reasons why real estate is so local, is it's different. You can't put a broad brush and determine it. If I did, I'd talk about one number. Days on marketplaces is 75th percentile. You can see Santa Clara County down here at basically 11 days. You can see that that's some of the record low. We did get down to 9 days for a brief period of time in 2022, just before the slowdown. You can see the slowdown here in days on marketplace started to increase by the beginning of second quarter, where we look like we're going to be flat. So we're not going to get any lower, but 11 days is basically the record low except for 2022. So except for most of the first quarter of 2022, this is the fastest the market is turning over as measured by days on marketplace. It's not the fastest DUI, but the fastest time on the marketplace. You can see San Mateo County in the orange was horizontal from last week. It's something like probably 15 days, and Alameda County has been improving and reached the San Mateo level at 15. So San Mateo and Alameda County are tied at 15. Santa Clara County is the fastest at 11 days to sell 3 out of 4 of your sellers. Now you're looking at the magnitude of price reductions. You can see that Santa Clara County is rapidly approaching no seller price reductions. If I'm doing my math right, that is less than half of 1/10 of 1% of the price reduction for Santa Clara County. San Mateo County is just over 0.5% price reduction, and Alameda County is about 0.75% of a price reduction. Frequency of price reductions. So how common are price reductions? Least common here in Santa Clara County, where you're rapidly approaching only 5% of the sellers are doing a price reduction. Again, the only time less than that was first quarter of 2022. If we look at San Mateo County, it's actually already turned around fairly significantly. It went from, say, 6.5% up to 10%. So a significant number increase in the number of sellers that are doing price reductions in San Mateo County. So sellers there appear to already be going, wow, we got to reduce our price more frequently. And then Alameda County is still coming down like Santa Clara, and there now 1 in 10 of the sellers in Alameda County is doing a price reduction. This is the magnitude of overbidding. There's frequent, see that we'll talk about next, but the first is the magnitude. How large is the overbidding? The overbidding is the most in Santa Clara County at 6.5% over the seller's ask price. Next is San Mateo County, roughly coming in just under 5% overbid. And then in last place, which still is significant, almost 4.5% over the seller's ask price for Alameda County. You can see all three have turned around. Now, keep in mind, again, there's a lag time here. So these turnarounds, as far as when offers were accepted, actually happened probably at the very last week in 2024. So somewhere right in around the holidays, when buyers weren't out there, that's when the buyers started saying, hey, let's get aggressive. Let's buy a house this year before we get more competition next year. And the overbidding actually got pulled forward into 2024. Here's the frequency of overbidding. So how common is it? It's 68%. So basically just over 2/3 of the sellers in Santa Clara County are getting more than their asking price. San Mateo County in the orange is just above the gray. You can sort of see the gray is probably at 58% and San Mateo County is probably at 59%, but we can call that a tie for just under 60%. Clearly, Santa Clara County has a little bit more overbidding, but not significantly, but that's still going to be something like 12% more overbidding relative on a percentage basis than Alameda and Santa Clara. Here's the long-term appreciation. And this is using the last 9 months of 2015. Basically, this time frame right through here where prices were fairly stable compared to where they typically are. You can see that San Mateo County was probably the least stable, but they were fairly stable, and you got to pick a period. Another period of time I might pick was 2020, but that was so bizarre with the pandemic. You don't really want to pick that as your base. And ideally, I would take a whole year, but there isn't really a year where the prices are flat because of the run up here we have at the beginning part of first quarter that I wanted to try to eliminate. So anyway, I used the last 3 quarters of 2015 as my benchmark. You can see that San Mateo County here in the orange is for the most part on the bottom, but Alameda County has come up and caught up. And now Alameda County is underperforming San Mateo County for the first time. And that may be, I blame a lot of this on the pandemic. In fact, if you come back to the pandemic, before the pandemic, all three counties were doing the same. Since the pandemic, San Mateo County clearly came down first, and then Alameda County sort of followed, and Santa Clara County is doing the best. So Santa Clara, for whatever reason, has benefited, whether it's closer in commute, but reasonable. You're not paying a huge premium like in San Mateo County for being close to work. Whatever the reason, Santa Clara County has a little bit over 200% of the price it was in 2015. So that's 100% appreciation. San Mateo County is second with with about 65% appreciation. And in third place is Alameda County at something like 55% appreciation. Here we're looking at the median sold price of the three counties. You can see Santa Clara County now shot up again above San Mateo County. Last week they were almost even, with San Mateo County being slightly higher. I think the actual numbers for last week were San Mateo County was at $1,875 and Santa Clara was $1,850. So $25,000 with San Mateo County being more expensive. And you can see that historically, San Mateo County has always been more expensive than Santa Clara. There's been a few times when we've been tied, and there are a couple of times when they reversed, including a couple of weeks ago, like right at the end of the January. And then last week that they were just, San Mateo County came back up. But this week, Santa Clara County did a huge jump of $110,000, whereas San Mateo County only jumped $13,000. And so now Santa Clara is the winner at $1,960. Median price home in Santa Clara County is now $1,960,000, where the San Mateo County median price home is $1,888,000. Again, a reversal of about $75,000. I think our biggest reversal we had was late last year at $100,000. So clearly something is shifting on these counties with Santa Clara and San Mateo County relative to each other. And then the most affordable county is down here in Alameda County, and it's something about $1,160, $1,160,000 in rough numbers. Here's the same information on regular paper, and you can see Alameda County is closer to $1,150,000. It's easier to read on linear paper, and then you can see Santa Clara County is just above the $1,950,000 that I would read if I didn't have the number in front of me. And then San Mateo County is below 1.9, and that's because the actual number is 1.888. Clearly a reversal. Here's the estimated payments that are going to be in the same order as the price. So Santa Clara County is coming in there with a monthly payment of around $15,000. Again, this assumes an 80% loan at the high balance conforming Freddie Mac rate. Jumbo money would be less. A lot of people here in Silicon Valley have relationship banking pricing the opportunities through their retirement or their 401k or their stock investments. You don't have to liquidate them. You just have to have the same financial institution manage them, and the dollar amounts aren't that significant compared to the price of the home. So a fair number of people are taking advantage of that progressive pricing. Now we're getting into micro markets. I think this is the most valuable information, in my opinion, because it's grouping similarly priced and acting homes that are contiguous geographically together to get what's happening. If you get down to the zip code level, you get so much statistical balance, the data is hard to make any sense or tails of. So if you group multiple zip codes together, then you start getting data that becomes accurate. And it's not the same level as a competitive market analysis, but it gives you an idea of what's happening in the different areas. So again, the color code's the same. Red favors the seller, a red hot marketplace. Blue favors the buyer, an ice cold marketplace. When you're talking about inventory, it's a lot of inventory favors the buyer. So basically you're looking at San Carlos, Belmont, the base cities of San Mateo County, and then Foster City, Redwood Shores, which is a fairly small micro market area. And for the first three graphs, I only have countywide data for Alameda County. I may start introducing a 5-year median next year for Alameda County and for the first three slides, because that way I could have some sort of a micro market area that's based on 5 years instead of 10 years. Anyway, the fastest area is Campbell with only 72% of the inventory. So you can see this is your reddest area, Santa Clara, Campbell, Willow Glen, and Cambrian, sort of the center part of Silicon Valley. It's got the least inventory at only 72%, followed closely by Cupertino, Sunnyvale at 81%, and Saratoga, Los Gatos at 86%. Basically, I'd go about 12.5% on each side of 100 for a normal marketplace. Same concept with the number of offers. Here, blue is a lack of offers because that favors the buyers. You can see that the coast is clearly has a lack of offers. They have less than half the offers that they typically do based on the past 10 years. North San Mateo County also is lacking almost 30% of the marketplace. Overall, you can see that blue shade across. Also not on the map is I have all of Silicon Valley. So you can see that all of Silicon Valley for offers is at 91%. Santa Clara County is at 88. So it's missing more of the offers than Silicon Valley. San Mateo County is at 91.9. So that's about dead on. And then Alameda County is a little bit high, the highest at 93.6%. So Alameda County's got the most number of the highest percentage of offers being accepted. Here's your days on the unsold inventory. And all three of these metrics are being compared to the metric themselves over the past 10 years. And the median for each metric happens in different years. So your median inventory, your median offers accepted, and your median days on unsold inventory are happening in 3 different years. And therefore, you can't do the math to get 100% when you think you should. And I've looked into it multiple times to convince myself of that. Again, you have the countywide data at 110%, so 10% slower. Santa Clara County at 99%, essentially right at normal. San Mateo County at 123%, so significantly lower than Silicon Valley as a whole. That's what's pulling Silicon Valley down. And then Alameda County is slower than Santa Clara at 110%. So Santa Clara County is the fastest and being slightly faster than a normal marketplace, although I call it normal. You can see there are areas in Cupertino and Sunnyvale, and even Campbell, Santa Clara, Willow Glen again is a little bit hotter than normal, so that's a little bit faster paced. The affordable areas in Santa Clara County are slower. And again, you can see a large chunk of San Mateo County is slower than it normally is. Here's your raw count of days unsold inventory. So now we're saying, ignore the past, just what is the marketplace today? So despite the marketplace being slower than it normally is, it's still red hot. Silicon Valley typically is a red hot marketplace, and now we just have a red hot marketplace. What am I talking about? Well, you're selling all of Silicon Valley's inventory out in just over 5 weeks. That's very, very reasonable. Santa Clara County is at 29.9, so call it a month. San Mateo County is going to be a little bit slower at 40 days, and Alameda County is the slowest at 42 days. But still, to sell out your whole marketplace in 42 days is fairly fast. You have to get up into the 42-day range. You can see that here's my index at the top. Basically, 6 to 7 weeks is what I'm considering to be a normal marketplace. Anything under 6 weeks is favoring the seller. Now, here's again just raw numbers. How long is it taking 3/4 of the sellers to sell? And you can see for Silicon Valley, it's 2 weeks. Santa Clara County, 11 days. San Mateo County, 15 days. And Alameda County coming in at 15 days. And then you can see the longest days that I'm picking up real quick is Atherton at 53 days. And it's sort of interesting that even though the Half Moon Bay is only seeing 50% of the inventory, they're still 3/4 of the sellers are selling in 40 days. Here's price reductions. So how common are price reductions? Red is favoring the seller. So a price reductions means very little. In the case of the affordable areas, it's actually a 0.5% increase. I actually looked at this data because it sort of was a red flag to me. And the reason it's 0.5% price increase for the affordable areas is it turned out one listing came on the marketplace and they doubled their asking price when the offer came in. So I forgot what the exact numbers were, but we'll make up an example. They were asking $750,000 initially. The offer came in the door. They probably sold it for $1.5 million. The listing agent and seller decided that they wanted to raise the ask price to the price the offer came in, so the appraiser wouldn't question it. And I'm not sure any appraiser worth their salt would go back and look at the history and would see the price increase, but that's what happened. That one listing doubling their asking price was a huge increase. And on average, that's what happened. That's why looking at averages is not so good. Is it worth reinventing the wheel here? Probably not. But if I was to do it over again, I'd probably do this metric on some sort of percentile. The median is always going to be 0, so you can't use the median. Knowing about price adjustments, I would probably do something like the 90 percentile, but then people question me, why am I picking the 90 percentile? I'm doing the 90 percentile because it's what would actually reflect the market the best. Here's the frequency of price reductions. So even though, look at for the same affordable areas in Santa Clara County is now a fainter shade of pink. That was the red flag. How could you have such a red hot average and yet it not be red hot on the frequency? You have one seller that's that outlying, that seller that was on the market for 2 years selling, pulling up your average days on market. Well, it pulled up my average price reduction and, is misrepresenting. What do I think the real number is? Instead of being up 0.5%, I'd probably say it's down 0.5%. So it's It's not a huge error in magnitude, but it's the wrong direction. And you got to be careful with statistics. You can make them say anything you want them to say. I struggle to try to make them make sense and to reflect what the market's actually doing. I don't care what way the market goes. My value to the consumer is providing them factual, accurate data that they can make their decision based on, and I'd be happy to work on your individual case with you to figure out what you should be doing. Here's the magnitude of overbidding. So what's happening between the ask price and the offer price that the buyers come in at? You can see that the Half Moon Bay, the coast areas is the blue, 5.5% price reduction. I mean, I'm fully saturated at 5%. That's off the scale in price reductions. Atherton at 1.5% price reduction. And again, my scale's up here. So anything from a 1% price reduction to a 1.5% price overbid, I consider to be a normal marketplace for Silicon Valley. And then you start getting the red color once you go over 1.5%. So you can see the bulk of the valley is getting overbid. And you can see in Silicon Valley, it's 5%. Santa Clara County is 6.5%. San Mateo County is 4.9%. And Alameda County is 4.4%. So Alameda County has the least amount of overbidding. Here's the frequency. So how common is the overbidding? 0% in San Mateo County coast. You can't get lower than that. And I go saturated at 15%. I'm doing these on 15 to 33%, 33 to 50% is a balanced marketplace, and anything over 50% starts to favor the seller. You look at this map, and basically more than half the sellers in most of the areas are getting more than their asking price. Here's the appreciation. You can see the close-in areas in the Tri-Cities area in Fremont is doing pretty well. Pleasanton now is doing pretty well, where Livermore is doing terrible. And the affordable areas, the longer commutes, but within Santa Clara County, are doing the best in Santa Clara County. Most of San Mateo County is blue. I did not investigate this. I'm shocked by this, but I could look into it maybe and report back next week. San Mateo County coast is actually showing above average appreciation, even though they're getting below their asking price. They're at 91% appreciation. That's higher than the Silicon Valley average of 80%. That caught me by surprise. I didn't have time to research it, but maybe I'll look into it and report next week. Here's your sold price. Almost everybody follows the median price, which is the middle number. The number to the left is the 10%, the cheapest you'd expect to find in that area. And the number to the right is the most expensive you'd expect to find in that area. So you quickly get a price range. Here, red favors the seller because they're getting a lot more money. Blue is lower, more affordable because it favors the buyer. And you can sort of see the more median priced or white in color. Here's a summary of the slides. You can start over on the left-hand side with your different micro market area, read across and see the micro market condition. And you can see here in the affordable areas that 0.5% price increase sort of sticks out compared to everything else. Everything that's the brightest red. You're normally a little bit more consistent. Or you can start over on the right-hand side with either your estimated price range that you feel you can afford, or if you met with a lender, what your price range is, and then figure out what your market conditions are going to be. The bright yellow are your leading indicators, your fainter yellow is quasi indicators, and then the inventory and the offers really don't tell you what the market's doing by themselves. Together, they make a lot of sense, but individually, they don't help. And the orange are lagging indicators because you have to wait for those escrows to close. Here now is the raw numbers for Santa Clara County, San Mateo, or Alameda County, or Silicon Valley as a whole. You can see that we've been getting increasing number of new listings, up overall 7.5%. And this is new listings coming on the marketplace. The inventory is growing. We're up 8%. The number of offers accepted now is outpacing the number of new offers. That doesn't surprise me. Remember, this is a holiday week. Every holiday negatively impacts real estate. The bigger the holiday, the bigger the impact. The sellers don't put their house on the marketplace, but buyers still buy their property. So we'll see some changes most likely next week. Days on unsold inventory, the speed of the marketplace is improving. That's a negative, which is an improving marketplace. The lower the number, the faster the marketplace turnover rate is. And I have the appreciation since 2015, as well as the appreciation since the pandemic. And the area that's done the best since the pandemic is Santa Clara County at 43%, San Mateo County at 18%, and Alameda County at 14%. So this table is showing the number of offers accepted in the past 5 weeks. You can see that now we have 4 weeks in a row going back to early 2025. Basically, the month of January is the record low in the past 25 years. So we're accepting fewer offers than we have any time in the past 25 years. Now, the numbers are close, 943 versus 911, 852 versus 814. 802 versus 798. That's only a difference of 4. So we're missing 4 transactions. And you can't get closer than this without a tie. 847 last year versus 846. It's only one less, but the big thing is you're not increasing sales yet. Now, starting on January 31st, basically 3 weeks ago, you're coming in second place. Will these they'll get lower because we'll have transactions fail. Will they get below the 2024 levels? I don't think so. It's going to be close. It's too early to tell because these numbers will decrease and there's no way to know how many transactions will fall apart until they fall apart. By this week, with having 1,800 outperforming by 130 listings, I don't think we're going to lose 10%. That would be a lot of transactions falling through. So I think this week we're safe being in second place. The previous two, it'll become close to the record low, but if you're the 24th or close to the 25th lowest year out of the last 25 years, that says something. The buyers just aren't out there buying the properties. We have been talking about the Silicon Valley real estate marketplace. We will be talking about the Greater Bay Area, 13 counties, 5 regions in a few seconds. Please consider subscribing and liking my videos. It does help me out. If you want to go to the YouTube channel, type in the blue YouTube URL up here, or you type in the shorter green root URL. It takes you to the same location. If you want to participate live Saturday morning at 9 a.m., type in the green root URL and add in 2025 for the year. If you want the handout, 67-page PDF handout of the PowerPoints that I've gone over, type in the green root URL, H for handout, the year 2025, the month 02, the day the 15, and you'll get that presentation. If you want a particular past episode, the tiny green root URL, year, month, date code without the H. I'm Richard Calhoun, real estate broker with Creekside Realty. My contact information is there for you. I'm representing buyers or sellers in Silicon Valley. Happy to talk to you about your real estate wants, needs, or questions. Moving on, we'll now talk about the Greater Bay Area. First is Silicon Valley that we've already been talking about. Next is the city, San Francisco, Marin, North Bay, Central Valley, San Joaquin, and Sacramento, and Central Coast being Santa Cruz and Monterey. And it is noteworthy right off the bat here, Santa Cruz, Monterey in the blue is losing inventory. The other 4 major regions are gaining inventory fairly significantly. But if you look at the blue, it is not unusual for the Central Coast to be having decreasing inventory early in the year. Yes, they typically turn around and start increasing, but look at last year, they had this little dip. So each region, each micro market area has its own characteristics. Here's the number of offers up in all 5 regions, up very sharply in the 3 big regions. It appears to me that the cities and the Central Coast are not up quite as steep. In other words, the slope of these 2 lines is not as steep as these. The steepest from my perspective is Silicon Valley, then probably North Bay, and then the Central Valley, then probably cities, and last place is probably Central Coast. I could actually line them up, but I did not do that. Here's looking at the marketing time, down in all 5 regions. There's a little bit of hint that the Central Valley may be leveling off, and also Silicon Valley may be leveling off, but they're all still going down at this point. I'd expect them all to be lower next week. Here's marketing time, the 75th percentile, so 3 out of 4 sellers. It is noteworthy the Central Coast looks like it's leveling already close to being level. The North Bay and the gray line up here looks like it may be leveling off. Central Valley is still down, but maybe hinting. Cities is definitely straight down, and Silicon Valley is, or at least hinting at leveling off, but it's down to 12 days. I mean, you can't get much lower than that. In fact, if you go back lowest in time that I'm seeing is 10 days. I'm sorry, that's 14 days, and that's close to the lowest except for 2021 and 2022. Ask price reductions, where are they going? They're going down in all areas except for the Central Valley. What does that mean? That means sellers are starting to take larger price reductions this week than they did last week, which must mean they're starting their expectations in market reality. Their expectations were greater than market reality. That sort of bodes of a soft marketplace. But they're clearly increasing right now in 4 out of the 5 regions, and even the exception in the Central Valley that I mentioned is leveling off and close to flat. Frequency of price reductions still going down in Silicon Valley, flat in the cities, going down in the North Bay. They're going down in the Central Valley, flat in the North Bay, and I don't know what we want to call that for the coast. It bounces around too much, so no comment on the coast. Overbidding, how much overbidding is going? Central Coast is the least amount of overbidding and going down. Central Valley and North Bay are fairly flat and pretty close to 100%, so sellers getting just their ask price. And the 2 regions that are getting significantly more than their asking price is Silicon Valley and the cities, somewhere around 5% above the seller's ask price. Frequency of overbidding, Silicon Valley has the most overbidding at 62%, then the cities at 50%, North Bay at 40%, Central Valley at 33%, and actually 34%. And then finally, in last place is the Central Coast at around 25%. 1 in 4 sellers getting more than their asking price. Here's the long-term appreciation. The cities clearly has the least appreciation. That too triggered with the pandemic. Then next is North Bay, Central Coast. Silicon Valley is in 4th place, 2nd place, actually, I guess, if you want to go from the good way, at 80% appreciation. And the area with the highest appreciation is the Central Valley with about 86% appreciation since the last 9 months of 2015. Here's the median sold price for the different areas. You can see Silicon Valley is outperforming the cities. Again, that's a reversal of where we've been, just like there's a reversal between San Mateo and Santa Clara County. When you have these reversals, it's clearly something that happens. I would have always thought that San Mateo County would be more expensive than Santa Clara County. I've taken a few clients into San Mateo County and they felt that they got better values for their money there. It is shifting. Central Coast is in the middle of the packet, just over $1 million. Then the North Bay is somewhere around 750,000, and the most affordable area is the Central Valley at about $530,000. Here's the monthly payments. They're going to be in the exact same order because they're all assuming an 80% 30-year fixed mortgage. And here's the numbers. If you haven't joined me for a couple weeks, the numbers, the now column, that's this current week. Then I'm giving you a week percent change from a week ago and a percent change from 5 weeks ago. So you can see inventory in Silicon Valley is up dramatically. Marin from 5 weeks ago is getting fairly flat at single digit. So is your North Bay areas. Most of them, except for Contra Costa County, is double digit. The other 3 are single digits. So it's really only Silicon Valley that has these huge swings, or their swings are more progressed. Then you can see the offers, and this is actually interesting. We actually still have lower offers being accepted now than we did 5 weeks ago for Alameda County and for Santa Clara County. So that's how you read these. Let me know if you would rather have different metrics going back in time. Maybe you want now 5 weeks and a year ago, because 5 weeks would be about a month ago instead of just a week ago. I'm receptive to hearing what people are interested in seeing, if anything. Yes, there's a lot of numbers, but the more data, you can look at what you want and ignore what you don't want. So again, on these chapters, you can jump to the segment every week that fits your particular interest the most. And I'm not seeing any unmuted mics, so have a great week. Take care. Thanks for joining. Bye for now.